All right, so on to April's transaction. Purchase goods on credit for €14,760. This included VAT of 23%. Okay, so we're going to see VAT a couple of times in this question. So VAT on purchases here. Purchase goods on credit for 14,760. So you owe the person you bought those from 14,760. So that's a creditor of 14,760. So let's add 14,760 to creditors. Okay, so straightforward enough. Now, that 14,760 included VAT of 23%. So that 14,760 is after VAT has been added on. So that's like 123%. So we're going to split that up into a 23% and into a 100%. Okay, so the 23% VAT, when I purchase something on VAT, I am able to reclaim that VAT from the revenue commissioners. Okay, so whatever the VAT element here is going to go into my VAT account. Now, on purchases, you're able to reclaim the VAT. So if there was no VAT at all in this question, I would be putting the VAT up here in assets because it's money that you can reclaim. It's money you're owed. But you'll notice there's a VAT amount already there in liabilities. Okay, so rather than having a VAT liability and a VAT asset, what I'm going to do here is I'm going to adjust the VAT liability. Okay, so first thing I'm going to do is just figure out how much is that VAT amount. So the 14,760 I said was 123%, and the VAT amount then is just the 23%. So divide by 123 and multiply by 23. That's 2760. All right. So that 2760 is money that you can claim back. So you, as I said, if there wasn't VAT already in this question, I would be creating a VAT asset of 2760. So what I'm going to do is take 2760 away from my VAT liability. So instead of having to pay €8,400 over now to the revenue commissioners, I'm going to have to pay over, subtracting those amounts from each other, 5,640. All right, the difference between them, the €12,000, that's how much you're actually getting into your stock. So you're going to add that €12,000 into your stock. Okay, so the goods you're buying are actually worth €12,000, and then there's a VAT amount on top of that, but it's the 12,000 that goes into your stock. Okay, and there you see 12,000 added on to assets, 12,000 added on to liabilities as well. All right, on to June's transaction. So received a bank statement on the 30th of June showing a credit transfer received of 7,200 and a direct debit of 4,800. So that is credit transfer received. So that is credit transfer is going to be money coming into you. So that's €7,200 received that I haven't put into my bank account, in my accounts. And a direct debit, that's to pay bills. That's money going out. Okay, so that needs to go into my bank account as well. All right, so I've got a bank overdraft here, so money coming in is going to be subtracted from it. So take away 7,200, add on the 4,800. So take away the 7,200 and add on the 4,800. That is €2,400 coming into your account, so reducing your overdraft by that amount. All right. The other bits of the question then, so received a bank statement. 7,200 is to cover 8 months rent received in advance. So some of that's going to be for this year, some of it's going to be for next year. We're going to deal with the this year, next year split later in the question. All right, that's why we have that second column for December. For now, I'm just going to put in rent receivable of €7,200. Okay, and income receivable is a liability. All right, so down here, another new liability created. So rent receivable, €7,200. All right. The other one, just be careful here, easy to misread this one. So a direct debit of 4,800 to cover security costs for the year ended 30 April 16. Okay, so initially when I was reading through this question, I read this as April 17, so some of it was for next year, but it's actually ending April 16, and we're doing the accounts for 16. So that €4,800 is paying for security costs from last year and for this year. Okay, so if you look in these accounts, there's expenses due at the start. Okay, that's where this €4,800 is going. Okay, so if you think about it, that €4,800, that's to pay for something right up until the end of April 2016. Okay, so like only 4 months of that is for this year, 8 months is for last year. So that's what that expense due is. Okay, or some of it anyway. We'll see at the end, it's not all of it. So there's expenses due of €6,000. Okay, so we actually owed €6,000 to someone for expenses. So I'm going to put the €4,800 in there. Okay, so that's those expenses due actually being paid. Okay, so now we see the assets and the liabilities both sum to zero. Okay, we'll deal with the fact that in the case of rent receivable, some of it's for this year, some of it's for next year. For the expenses due, some of it's for this year, some of it's for last year. We'll deal with that when we come to December and what needs to go in this year's profit and loss. But for now, we just deal with them on the balance sheet like that. And we'll, as I said, do the other half of it in that second December column. On to July, where I've got paid by check a creditor account balance of 1,800 and received a discount of €100. So paid the balance of €1,800. So there's a creditor balance of €1,800 gone. So I'm going to take €1,800 away from my creditors. I received a discount of 100. So I only actually had to pay €1,700 to get that balance written off. So that's €1,700 coming out of my bank. And just remember, it's an overdraft, so money coming out, you add it on. All right. So what's the difference? The difference is the discount received. Okay, discount received is other income in your profit and loss account. So you put that in your P&L, you add €100 on. So that's where you recognize your profit. Your discount received. Okay, and again, you notice the asset and the liabilities both sum to zero. August then, it's got 2 parts to this one. So first part, a payment of €900 was received from J. Barry, a debtor whose debt had been previously written off. This represents 60% of the original debt, and Barry has undertaken to pay the remainder of the debt. So €900 was received. So let's put €900 into the bank account. So overdraft, so that's minus 900 for received. This represents 60%. Okay, so that's 60% and the full debt had been written off. So when a debt is written off, that's an expense in your profit and loss account. So we've already written off that full 100%, but now I have received the money and I've received some of it and I'm going to receive the rest of it. So that's not a bad debt anymore. Okay, I'm actually receiving the money, so I need to undo that €1,500 expense. So I'm just in my head, €1,500 expense. Okay, the 100%. Okay, so I go to profit and loss, and I go, the €900 that I have received is 60%. So I just figure out what was 100%. It was €1,500. So I would have put in €1,500 bad debt written off, But now I'm undoing that because I'm actually receiving that money. It's not a bad debt. So I'm going to add the 1,500 euro. So you're undoing the 1,500 euro expense. What's the difference then? The difference is he's going to pay the remainder of his debt. Okay, so the other 40% of this, he's going to pay me that. So money that you are going to receive, that's a debtor. Okay, so just 40% of the 1,500, that's 600 euro going in to debtors. Okay, so now you see 600 added to assets, 600 added to liabilities. That bit of it balances now. Okay, so that's the 40% I'm going to receive, that's the 60% I have received, and that's the 100% kind of being undone. Now, the second half of this, on the same day, goods to the value of 369 were sold on credit to Barry. This includes 23% VAT and markup on cost of 20%. Okay, so kind of nearly two parts to this second part. So goods of 369 were sold on credit. So that's another 369 he owes me. So that's 369 being added on to my debtor. All right. So add 369 onto that because you're selling him another 369 worth of stuff. All right. So now there's another 369 being added to that. Now that 369 includes VAT of 23%. All right, so you are going to figure out what's the VAT element of that, and that's going to go into your VAT account. All right, so you're going to go 369 includes VAT at 23%, so divide by 123 and multiply by 23. So 69 euro is going into your VAT account. Am I adding it on or am I subtracting it? Well, on sales, you receive the VAT and then you need to pay it over to the revenue commissioners. So yeah, that 69 euro is money you owe to the revenue commissioners. So you're right to increase the liability for that. Okay, so VAT on sales, you owe it to revenue, so it creates a liability. VAT on purchases, you're owed that, so it creates an asset, or in this case, as we saw earlier in the question, reduces a liability. All right. So of that 369, 69 is VAT. So 369 take away 69, that's 300 euro of an actual sale before VAT. And I am told that that 300 euro includes a markup on cost of 20%. So there's a profit element to that, and then there's an element of goods coming out of my stock. Okay, so the 300 euro, before I ever worried about VAT, that included markup of 20%. So that 300 euro was 120%. Okay, 20% of it is profit, and the 100% is what's coming out of stock. All right, so I will go up to my stock, and my 300 euro, I'm going to divide it by 120 and multiply it by 100. So before I added on that profit of 50 euro, that stock was worth 250 euro. That was the cost price, and it's that cost price that comes out of my stock. All right. The difference then between the 300 and the 50 euro, that's profit. Okay, so that gets added on in your profit and loss account. All right, so I'm going to add 50 euro on there. All right, and then I noticed that this doesn't balance, so have I made a mistake here somewhere? I think the 719 is correct. It's, oh yeah, sorry, it's because I got a formula there, so that should just be 1500 by. So now, yeah, they're both 719 now. All right. So you kind of have two things to do there. You have to kind of undo the VAT, and then you have to undo the profit to get back to what comes out of stock. All right, but we see the VAT coming up again and kind of understanding how VAT works. And I think it's going to come up again later on in the question.